This is Charles Sachs, Managing Director with Private Wealth Counsel. Thank you for joining me today to listen to a presentation I recently made for the Weitzman Institute of Science titled Ways to Maximize Income and Tax Benefits in the Current Tax Climate.
He has a master's degree in business administration and honors from Florida International University. He's currently the president of the Financial Planning Association of Miami. He's vice president of the Estate Planning Council of Greater Miami. And Charles also hosts, and I've had the good fortune to being a guest on the show, he hosts a radio show called Straight Talk on Your Money, which airs on 8:80 a.m. Listen to the show at 3 p.m. on Thursdays. There's a call-in feature on this show, and you can speak to Charles on the radio. So without further ado, Mr. Charles Sachs.
Richard, thank you so much for that introduction. He read that exactly the way I gave it to him, so thanks so much. One of the things that happened is for a select group of people, one of the biggest tax increases went through in modern history, and we'll talk a little bit more about that. But let me ask you by a show of hands out there, and I talk with people all the time in my financial practice, how many people actually don't mind paying taxes or actually enjoy paying taxes? I've got clients who enjoy paying taxes. They feel they should pay their fair share. You even hear some Warren Buffetts of the world out there talk about wanting to pay more than their fair share all the time, don't we? We hear about that. So my point to you would be, for those who do like to pay more, there's a website. If you search Treasury Direct, you can go online. You can pay as much in taxes as you'd like to do, and you're donating it to lower the federal deficit. So by all means, go and find this website, pay as much as you'd like to do. And yes, in case you're wondering, making that payment to the government in the form of a gift to lower the national deficit is tax deductible. So I like to go in there and give them my 2 cents worth every once in a while about what they should do with the money, so you can go and do that. For the rest of us out there, however, this usually is the way it feels, and that while people would like to give their fair share, they may maybe be comfortable only giving half as much to do that. So our objective today, within 10 to 12 to 15 minutes, is to go through a variety of these things. Well, what we're trying to do today, for the end of the year, is talk about some strategies that you can do to lower your taxes before you get that big bill. So that's our objective. The other thing also is to leave here learning at least one thing. Hopefully you'll learn one thing. The American Taxpayer Relief Act of 2012, that was actually passed on the first day of 2013 because Congress couldn't decide in 2012. They talk about relief. I think we've known from this administration, whenever they use a word in something, affordable Health Care Act is arguably not affordable. The Tax Relief Act is not relief. It's more like indigestion for a big swath of the population, and we'll talk about why. And you know, the Republicans forever talked about no new taxes, no new taxes. Well, somehow some of the biggest tax increases went through for a certain segment of the population. And so we're going to talk about who those people are and who those people aren't. So how many people think this statement is true? How many people think this is false? One false. How many people have no idea? Well, the current misconception is that for whatever reason, and there's reasons as we'll get into, that people think perhaps giving to charity is less desirable now than it was in 2012. Actually, that statement is true because if you're arguably in a higher tax bracket and you're able to give to charity, now the taxes you would have paid on that charitable item, you're saving more. Even if, and we talked a little bit about these phase-outs, the phase-outs that they might have usually don't hit people, and that's rather complicated. If that's something that you're interested in, we can talk a little bit more about, but the bottom line is we'll talk a little more about that. Some of your deductions are going to be taken off the table. It's very unlikely your charitable deduction will be impacted. So here's how that lays out, and we're going to walk through it. Below $250,000 of what they call adjusted gross income, which is your wages, your interest, your dividends, all the things that you put together, you're below that, doesn't hit you. They're smiling. They're not smiling because here's when you start to run into some problems. Combined income, and we're talking about a married couple. If you're single, it's a little bit less than that, but I didn't want to confuse it too much. So, boom, the first thing that hits here, this new tax here, above $250,000, what they're calling unearned income. Simply put it as that. It's not a wage. So this would be interest or dividends, or when you have capital gains, anything that's unearned. All of a sudden, the government will be taking an additional 3.8% of taxes on that amount of dollars if you're above that $250,000 mark. So that's number one bad thing to happen to you. Above $300,000, some things get even progressively worse. Personal exemptions, those are those exemptions you're allowed to claim for you and your spouse and dependents. Those can start to be whittled away a little bit along the way, and as you get up in there, eventually that can be completely eliminated, the personal exemption. And the itemized deductions reduced by 3% of income. Now, that's the part where a lot of people said, well, charity, many times charity can be an itemized deduction. And all you're telling me it can start to be reduced by 3% of your income above this threshold. But you can show many scenarios out there. While this may happen to you, it won't necessarily impact your charity. What it will impact is your other deductions. Our two largest deductions that we have here in the state of Florida are typically your interest deduction on your mortgage deduction that you have, and also your property. If you happen not to have a mortgage and or not to own a property with the taxes, this could impact you, but those are fewer situations that come up. Another new tax above the $450,000 mark for the married couple would be the new top tax rate of 39.6%. So it used to be 35%. So now income above that, we can round that off. The government didn't want to quite say 40%, but we could call that 40%. It's pretty close to 40%. And another tax on here, for the longest time, your long-term capital gains. You own a stock for at least a year and you sell it. You sold it at and you paid 15%, which was typically much less than what you would pay for your income. In this case now, 20% on long-term capital gains and qualified dividends as well. And so then, unfortunately, you combine both of those together for what we call, or what I like to call, the double whammy. You've got the unearned income tax on top of your regular tax. So when you run those out there, some clients of mine are fortunate enough to be in that new tax, the top tax bracket, 39.6. Unearned income, that would be from a bond or interest or CD or whatever you have. Added on top of that, 43.6%. Capital gains can be up to that, let's call that 24% when you put those two together. So double whammy. So that's the idea, is between now and the end of the year, if you happen to be in those situations, and you can be in them for a variety of different reasons, even if many of you are still not working right now, you have income that's coming in, pension income, Social Security income, maybe you have some income from your investments. So we'll talk a little bit about some strategies to try to mitigate or save you some. Well, when you have an annuity, if it's an annuity that did that, part of that gain would be taxable and part of it is not. So there's a formula based on that. And even when Stephen comes up and talks about the gift annuities through the Weitzman Institute of Science, some of that is taxable. Yeah, so tax deferred, whenever we talk about that word tax deferred, we're pushing it off into the future. So at some point in time when you bring those dollars out and put them in your pocket is when you'll start to pay some of those taxes. So the usual suspects, what can you do on here? Well, one of the things that you can do, probably one of the best buckets to pull from, if you're at least 70.5 years old and you have an IRA and you're charitably inclined, a great place to start. You've got a variety of different benefits. Because remember, after 70.5, the government requires you to pull out a certain amount, your required minimum distribution. When you pull that out, you're going to pay taxes on it. It's going to be added to all your other income, and it could push you into those higher brackets. Well, one of the best strategies would be to be able to give this directly to a charity. By doing that, it doesn't go on top of your existing income. There's no chance of it pushing you into a higher bracket. And there's no chance of losing that charitable deduction because of that phase out that came about. By and far, one of the best strategies, if you're 70.5 or older and you have an IRA. Here's an example of that with Phyllis. She's 72, so she is over 70.5. She has to take out at least $15,000 from her distribution. She wants to make a gift to Weitzman for the same amount, but was concerned about having to pay income tax. In this case, it's not counted. It goes directly to the charity. She doesn't get a charitable deduction, but she also doesn't have to pick up the income that she ordinarily would do. Directly to Weitzman or any public charity that you have out there. Another usual subject, and we talked about deferring income. Whenever you have the opportunity to defer income, it's typically a pretty good bet. You're pushing it off into the future. You're hoping at some point in time when you take that income out, your tax bracket may be lower. As an example, maybe, not an example, a real life client I was telling some of you, making a lot of money. They're in that top bracket. They're paying 40 cents on a dollar in taxes. She had the opportunity to defer some of this income because a deferral program, they had 2 of them. She was able to put $40,000 of deferred income into this programs and not have to pay the taxes on it. So if you figure 40% on $40,000 is $16,000. Now that's not a tax savings, it's a tax deferral, but if she defers it out to her retirement way down the road and brings it out at that point in time, hopefully she's not in that higher bracket because she's no longer working. Tax-free bonds. So those of you out there, the world has changed in that a lot of people weren't as concerned in looking at municipal or tax-free bonds as they were now, but that was before the new brackets went up. So in Florida alone, you're at the 43.6, and if you're a New York resident, you're over 50%. So you're basically, if you're in those higher brackets, you're taking your dollars that you're getting from your investment, your interest from your bank account, you're cutting it right in half. You get half, the IRS gets half. Yes, what we're talking about is the advantage of using a tax-free bond. So if you don't have the tax-free bond, half of it you pay in taxes. If you get the tax-free, the municipal bond, one of the nice things that the federal government has said is to the municipalities out there is that we're not going to charge anybody taxes on the interest you pay them. Therefore, those municipalities can pay a lower interest. They can offer them up to you, and they can save money. And they're a benefit to you because you don't have to pay income taxes on the income. A hidden suspect here, to be able to reduce or lessen taxable income when we talked about this, elimination of capital gains from an appreciated asset. What are we talking about there? Well, let's look at that. Look at the example. Sherry has a huge gain of shares in XYZ Corp. It's a stock that she's owned. Her grandma gave it to her 20 years ago. So she has this, but she's thinking of selling it. So if we look at this example, her choices are to sell the shares, in this case, a market value of $110,000 to sell them. She only paid, or her grandma paid $10,000 many years ago, so there's a $100,000 gain there. She's in that top tax bracket, that's $23,000 and some change. She pays those taxes due. She then gives Weitzman or her favorite charity the remainder of the $86,000, as opposed to choice B. Instead of her selling the shares, she literally tells her broker to pick up those shares, pop them right down over at Weitzman. You get in touch with Richard. They do this all the time. The shares go over to the Weitzman. Weitzman sells them. They don't pay income tax. So in this case, the $110,000 goes directly to them. And there's a variety of different things that you can give to charity and save some money on. Here are some of those things that are out there. Now, there's a bunch of different things out there that you can give. You can be very creative. And there are organizations out there that will help facilitate taking in a variety of different assets that you have and being able to get them to dollars for a charity. So even if Weitzman themselves can't accept these gifts directly, there are other charitable organizations that will take those in for you. They will sell them and they will give the proceeds to whatever charity you would like to use. Now we're going to talk a little bit about a gift annuity when we talk about it. Annuity, in essence, you're buying a pension. You're buying a payment of streams over your lifetime. You're paying money in advance to do that. Social Security system is an example of an annuity where we pay into that and hopefully we get those dollars out down the road. So you may have someone, and this happens all the time. You would be surprised. I'm in front of clients all the time that have 5 or 10 or 30 or 50 or $100 million. They're all still concerned with the same thing. I'm running out of money. You would think, boy, I would be lucky to have that problem. If I had $100 million, I wouldn't be running out of money. But everyone thinks that way. So what can you do to somewhat assure to lock in that you're not going to be able to run out of money? As an example here, if we talk about it, here's a donor. They're 80 years old. They give $100,000 directly to the charity. And then the charity promises to make payments back to them. And there's a table that comes up based on their age. And it can change from time to time. In this case, $6,800 will go back to the donor for as long as they're alive. they live to be 140 years old, and as long as the charity's still around and they're solvent, you get those dollars. When it comes to the tax issue related to this, for pure charity, when you have a charitable, I'm talking about a charitable deduction and whether you have to pay taxes on it or not. If you just give money to a charity and you get nothing in return, that's fully tax deductible. If you give something to charity, as an example, Women on Vision. If you go there and let's say it's $250, if you go to that, part of that you're getting something in return. You're sitting down and you're eating a meal. Part of it you're making a gift. And so it's the same thing when it comes to your annuity. Part of that is you're getting something in return. Part of it you're making a gift. So to the extent that you're getting something in return, you are going to be paying taxes on that. So here are the current tax rates for the Weizmann Institute of Science that you have. Obviously, you're getting more dollars as you're older because your life expectancy is diminished. And the good thing about this is, Richard will tell you, anybody who buys these gift annuities seems to live to be about 140 years old. Because people have a feeling they're going to live a long time and they want to get their money's worth, and so they do that. So that's always good. Donor-advised funds. A donor-advised fund, think of it almost like a charitable checkbook where you could put in whatever you wanted to put into that, and then you can dole it out whenever you want to do that. The reason we're talking about this right now, you can stuff in as much money as you want and you get the immediate tax deduction. So if you do it before the end of the year, you can claim that entire amount on your taxes. However, you can pay it out whenever you want to do over your lifetime to whatever public charity you would like to do. So a donor-advised fund can be very, very powerful to be able to do that. So let's talk about two things we've talked about. Yes, it's like a charitable foundation. Many times a foundation, a lot of people say you should have at least a certain amount of money to start a foundation. Maybe it's $1 million, maybe it's $3 million, etc. It costs a lot of money to run a foundation. It doesn't cost anything to open a donor-advised fund. They can be done for $500. Many organizations you can do that. You can do that at Charles Schwab or Fidelity or the Miami Foundation or the Broward Community Foundation, etc. So as little as $500. What's also interesting is I've seen clients with $10 million. Just because you have a lot of money doesn't mean you have to have a foundation. Many times a donor-advised fund has a lot of benefits to use. So the answer is foundations, you should have a certain amount of dollars, but just because you have them doesn't mean this is off the table. Quite frankly, what you see is maybe a combination of both of those. So combining these two, so imagine if you will, and I've done this with some clients, we actually wrote an article on it. Actually, in your packet, there's an article about this exact strategy. Client had about $100,000. In this case, if he sold it, he would have paid a big gain in taxes. Didn't want to do that. So but he wasn't sure what he wanted to do with the dollars. He wanted to give to charity eventually. So what did he do? He combined the best of both worlds. You take that scenario where you have that stock from grandma that you paid 10 grand for. It's worth $110,000. You want to give it all to charity. You want to take the tax deduction in this year, but you're not sure which charities you want to give it to. You want to make that decision down the road. You can fund the donor-advised fund with that highly appreciated asset, whether it's a piece of real estate, a company, a stock, etc. In essence, it's like giving the way the billionaires give. If you think about the Bill Gates of the world or the Facebook people or whatnot, they have shares in these companies they paid nothing for. They're now worth billions of dollars. If they sell them, they pay now with the new taxes 23.8% on them. If they put them into a foundation or a charity, there's no taxes that gets paid on. You have to have a custodian or someone to hold the donor-advised fund. And just as the name implies, it's no longer your money. That money legally now is owned somewhere else, and you're advising them how to use the money. However, most of them will tell you as long as you advise them to give to any what they call a public charity, a 501c3 charity, they'll give it to you. If you try to say to give it to your nephew, Joseph, they're going to tell you no. So it's held by an entity. No, it's held by, you could do it at a community foundation. You could go to Charles Schwab or Fidelity, some of the discount brokerages. Many, many places hold them. And just because they hold them doesn't mean those dollars have to go to them. There has been some some issues there. Let's say you set up a donor-advised fund with the Greater Miami Jewish Federation, and it goes into their coffers in those pieces. Well, depending on the health of the organization, there could be, and there have been issues when in fact those dollars could go away. Generally speaking, the brokers, Fidelity and Charles Schwab, have billions of dollars in them, and they've done very well with them. But that is an issue of concern. And just like anything else in life, you could have more than one. So you could have some money at one with the other. Yeah, get the deduction right up front, immediately. Really, really nice thing to do. And another thing about it, and we'll get into some specifics. So if you go back to your attorney and say, well, Charles told me this great thing, I'm going to put $1 million in a donor advised fund and I want to deduct all of it. Well, he's then going to get out some rules and some things that can get complicated, and we'll be here till next year to do that. But the answer is that deductibility can be carried forward for 5 years. So if they say, you know what, because of these rules, you can't deduct it all in this year, we can carry it forward. So there's some strategies for that as well. So a real nice way to combine both of those. Remember that appreciated asset, real estate, some of those other things you'll see in your packet as well if you have them. If you sell them, you pay a lot of taxes. So being tax smart, just to recap, giving directly from your IRA, giving securities that have a large increase in value, establishing a charitable gift annuity, and Stephen, when he comes up, will talk a little bit more about that as well. And then establishing the donor-advised fund. So the quick answer to that is there's a particular rule when you're doing the IRA, it has to be direct to the charity, number one. It can't go into a donor-advised fund, and you can't do the annuity part because it has to be 100% of the gift, where the annuity is a partial gift and a partial benefit as well. Very good question. So exactly right. From the IRA is if you have the ability to be able to do that, it's probably the best way for you to be able to make that gift. Thank you for joining us today. And if you have any questions on any of the things we've covered, please give us a call. You can reach us at 305-444-1610.